Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Zhou Food Jewellery Co. Limited annual report. The primary drivers of revenue growth or decline can be identified by examining the key factors that have contributed to an increase or decrease in revenue for a company. On the growth side, several factors have played a significant role. Firstly, sales to a single customer increased significantly, contributing to a 44.4% rise in revenue. Additionally, gold jewelry sales saw a notable increase of Rm 194,271, while deepening cooperation with e-commerce platforms Tmall and JD.com also boosted revenue. The launch of the Myoji sub-brand for gold bars sales and counter-trend double-digit growth in online gold products have further contributed to revenue growth. Furthermore, increased profitability of self-operated stores, particularly fixed-price plain gold products, has positively impacted revenue. Market share consolidation in advantaged markets and counter-trend growth in emerging regions have also driven revenue growth. On the decline side, several factors have led to a decrease in revenue. Provision of services in China declined, as did sales of goods in China. The franchise model saw a 19% year-over-year change, while offline self-operated stores experienced a 5% decline. Service fees also decreased by 12%. Furthermore, the drop in sales volume of gold jewelry has contributed to revenue decline. Zhou Food Jewellery Co., Limited, market capitalization of $9 billion, is significantly larger than the average industry peer of roughly $0 billion. This shows that Zhou Food Jewellery Co., Limited, holds a significant advantage in their industry. Zhou Food Jewellery Co., Limited, trades at a higher price-to-earnings ratio of 11 times and a higher price-to-book ratio of 2.09 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company maintains a moderate leverage profile, with liabilities making up 35% of total assets, suggesting a balanced approach between risk management and capital efficiency. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The share count has remained broadly unchanged, indicating no significant dilution or buyback activity over the past 5 years. The income statement shows that the company have been growing its revenue annually and the operating income have been increasing. This shows that the business model works and the business is expanding. The net income of the company saw an increase of Rm 125.4 million, representing an 8.5% growth. This upward trend was consistent across different reports, indicating a stable and positive financial performance. The profit margins also experienced a significant change, with the gross profit margin increasing by 1.6 percentage points. Notably, the company's profit margins exceeded 8%, marking a notable achievement in its financial management. The reasons behind these changes can be attributed to several factors. Firstly, the omnichannel synergy and optimization of product mix contributed significantly to the net income growth. Additionally, the resilience in brand operations played a crucial role in maintaining stability. Furthermore, an increase in sales of gold jewelry and a rise in gold prices also had a positive impact on the company's financial performance. These factors collectively contributed to the improvement in profit margins and net income, demonstrating the company's ability to adapt and thrive in a dynamic market. The company's debt level and interest expenses have undergone significant changes. On one hand, the total current debt has increased, indicating that the company is taking on more short-term liabilities. However, this increase is offset by a substantial decrease in non-current debt, which suggests that the company is shifting its focus towards shorter-term obligations. In terms of interest expenses, finance costs have actually increased by Rm 0.2 million, implying that the company is paying more to service its debts. This may seem counterintuitive given the overall decrease in debt level, but it highlights the importance of considering both current and non-current debt when evaluating a company's financial health. Despite this increase in interest expenses, the decrease in total debt from RMB 641.1 million to RMB 426.3 million is a positive sign for the company's financial management. This reduction suggests that the company is actively working to manage its debt levels and may be on track to achieve long-term financial stability. The company's financial reports for the year 2025 reveal that it has indeed paid dividends to its shareholders. According to page 12, the total amount of dividends declared and paid in 2025 was RMB 395,208,000. Furthermore, on pages 32 and 33, it is explicitly stated that a final dividend of RMB 0.45 per ordinary share will be paid or has been paid. These statements confirm that the company has fulfilled its commitment to distribute profits to its shareholders through dividends. Concerns about inventory buildup and supply chain disruption are warranted. The current state of inventory levels is a cause for concern. A significant increase in finished goods, raw materials, and work in progress has been observed, with finished goods up 34%, raw materials up 125%, and work in progress up 74%. These numbers suggest that companies may be struggling to manage their inventory effectively. Furthermore, the write-downs of inventories to net realizable value have also raised red flags. The amount of RMB 70,000 is a relatively small figure compared to last year's RMB 8,664,000, indicating potential issues with inventory valuation. This could be a sign that companies are having trouble selling their products or managing their supply chains efficiently. Overall, the data suggests that there may be underlying problems in the supply chain and inventory management processes of these companies. That concludes the financial summary for Zhou Liu Food Jewelry Co. Limited. Feel free to comment below, and I will be happy to answer them when possible.